Here's something nobody tells you when you form an LLC: the piece of paper that actually protects your house and your savings. It's not your estate filing, it's a document most people skip because their state doesn't require it. It's called your operating agreement. And in a few states, it's just optional enough that people leave it out completely. Then something goes wrong, someone sues, and a court looks at your business and goes, "This isn't a real company, it's just you with extra steps." That's called piercing the corporate veil, and a missing operating agreement is one of the fastest ways it happens. So I'm going to walk you through writing one section by section in plain English. There's also one clause people leave out that wrecks them later, and I'll name it before the end. Stick with me because if you get this wrong, the whole point of forming an LLC kind of disappears. Quick reality check on what this thing is. Your operating agreement is the internal rule book for your LLC. Who owns it, who runs it, how money moves, what happens when someone wants out. It lives in your files. You do not send it to the state. You do not pay a filing fee for it. And here's why it matters, even if you're a one-person show. If you don't write your own rules, your state writes them for you. Every state has default LLC laws, and they kick in automatically when your agreement is silent. So if you and your partner split ownership 60-40, but you never wrote it down, some states will split your profits 50-50 no matter what you actually agreed to. The agreement is how you override the defaults and say, no, here's how we actually do it. Your bank's going to want it too. Most banks ask for your operating agreement before they'll open a business bank account, especially if you've got partners. Let's build the thing. I'm going to give you the sections every solid operating agreement needs in the order they should go. Start with the basics. Your LLC's legal name exactly as you filed it, the address, the date it was formed, and the name of your registered agent. This is the boring identifying stuff, but get the name exactly right, character for character, matching your state filing. Next, members and ownership. List every owner and list their ownership percentage. This is called their membership interest. If it's just you, you own 100%, easy. If there are partners, the percentages have to add up to 100, and this is where you write down that 60-40 split so the state can't override it later. Then capital contributions. That's a fancy phrase for who put in what. Maybe you put in $5,000 and your partner put in $3,000 and a laptop. Write down the dollar amounts. This matters because it sets the baseline if you ever sell, dissolve, or argue about who's owed what. Now, profits and losses, sometimes called distributions. How does money get divided and how often? Usually it follows ownership percentage, but it doesn't have to, and this section is where you say so. Quarterly, yearly, whenever there's cash, your call. Just decide now while everyone's still friendly. Next big one, management structure. You're picking one of two setups. Member managed means the owner runs the day-to-day themselves. That's most small LLCs. Manager managed means you appoint someone, an owner or an outsider, to run things while other members stay hands-off, more like silent investors. Pick one and write it down because it changes who's legally allowed to sign contracts and make decisions for the company. Then voting right. How do decisions get made? Are votes tied to ownership percentage, so the 60% owner outvotes the 40, or does everybody get one equal vote? And which decisions need everyone to agree versus just a majority? Taking on debt, adding a new owner, selling the company, those big ones usually need full agreement. Spell it out. Now, if reading all of this is making you want to close the laptop, I get it. There's a shortcut. Before we keep going, if you just want someone to handle all of this for you, Tailor Brands is the way to go. They take care of the LLC filing and give you a registered agent, help you set up your brand, the whole package. Check the link in the description. Okay, back to the sections because there are a few left that people skip and regret. Adding and removing members. What happens when someone new wants in or someone wants out? Without rules here, a member can theoretically sell their share to a total stranger, and now you've got a business partner you've never met. Write down that any transfer needs approval from the other members. That one sentence saves friendships. Next, what happens if a member dies, gets divorced, or just wants to walk away? This is called a buyout or buy-sell provision, and it's the clause I promised I'd name. It's the one people leave out, and it's the one that wrecks them. Picture this: you and your business partner own a company together. Your partner gets divorced, and suddenly their ex owns half their stake and shows up wanting a say in your business. Or a partner passes away, and their share goes to a family member who wants to be bought out immediately in cash you don't have. A buy-sell clause decides ahead of time how someone's share gets valued and who has the right to buy it. Write it now because you cannot write it after the thing happens. Then dissolution. How do you shut the LLC down if it comes to that? Who votes on it? How do you pay off debts? How does whatever is left get split? Quick and unsexy, but you want the exit written before you need it. And last, an amendment clause. This just says how you change the agreement later. Usually majority or unanimous vote of the members. Your business grows, things change, and you want a clean way to update the rules. Here's the step people forget. Sign it. An operating agreement isn't binding until every member signs and dates it. Get it signed, give each member a copy, and keep the original with your business records. Some people get it notarized. You don't have to, but it adds a layer of yes, this is real if anyone ever questions it. And one more thing for the solo folks. Even if you're a single member LLC, write one anyway. It's literally the document that proves your business is separate from you, and that separation is the whole reason you formed an LLC in the first place. Skipping it because you're a one-person shop is the exact mistake that gets that veil pierced. So that's the full build. Or like I said, you can let someone do it for you and you're done. Tailor Brands takes care of the rest for you. It saves so much time. That's why I recommend it to everyone. The exclusive discount link is down below. If this cleared things up, hit like so it reaches the next person staring down a blank operating agreement. Subscribe because I've got more of these coming. And drop your state in the comments. Those default rules I mentioned are different everywhere, and I'll tell you the one thing yours does that'll surprise you.